right. Well, thanks everyone for joining us again this week for the Capital Markets Leadership Series. I'm Sam Chandan, the Larry and Clara Silverstein Chair in Real Estate and Dean of the Shack Institute at NYU School of Professional Studies. I want to thank Arbor Realty Trust and the Commercial Real Estate Finance Council, CREFC, for their sponsorship of this program during the fall semester. The sponsors that we've had come in, during the summer and fall of this year, many of whom are long-standing supporters of the Shack Institute, just really want to again say how much we appreciate it. As you might imagine, many of our students have been impacted in terms of their ability to attend NYU by the pandemic, by disruptions in the job market. And so these sponsorships have really made a big difference for us. I just want to again thank for this series Arbor Realty Trust and CREFC. Really delighted today to be joined by Craig Solomon, co-founder and CEO of Square Mile Capital. We have a lot to talk about, including some really interesting deals that the team has done during the pandemic. I also want to mention how fortunate we are at Shack that Lori Golub is one of our board members, has been for a number of years. She's also the co-chair of our National Symposium of Women in Real Estate. And it's just been a real blessing for all of us at Shack to have Lori involved, LG, I should say, in our programs and in our work. This is a companion to our weekly REIT CEO series. So every week on Tuesday at this time, we interview a different REIT CEO. We kick that off with Sam Zell in July, and then Debbie Cafaro, Hap Stein, you name it. We've really had an amazing roster there. We were joined this week by Ann Segrest McCulloch, who's the head of an affordable housing, housing equity trust, so that was a slightly different discussion, very different perspective from our traditional office, market rate, multifamily, retail discussion, industrial, or even when Ron Havner joined us talking about self-storage. So please join us for that, as well as for our Thursday Capital Markets series across all of these different programs, which we've made sure to open up to students really no matter where they go to school. This is really mission driven for us during this time of disruption, but we've been really thrilled. Between the live sessions and the replays, we've now reached more than 35,000 people, which is a really great number for us, and a very small silver lining in the context of everything that's happening in 2020. Also really proud that we continue to make progress towards our goal of making sure that our programs, our speakers, our panels are as diverse and representative as our student population. So this summer and fall, across all of our programs, about 40% of our speakers have been women, and about 25% have identified with communities of color. We're not where we need to be, but we're continuing to get there. And I think anyone who knows Shack knows that this is an area that has been a key area of focus for us for many years. All of these replays are available on YouTube, with just a couple of exceptions. And all of this, of course, is a lead up to next week's 53rd annual conference on capital markets and real estate, which will take place on November 11th, 12th, and 13th. All the highlights that you'd find at our in-person conference every year are part of the program. The 22nd annual Golden Apple panel, Stephen Ross, Bill Rudin, Scott Reckler, Wendy Silverstein, Marty Berger are all joining us again this year for the Golden Apple. Jeff DeBoer, the CEO of the Real Estate Roundtable, will be joining us to give an update on the real estate industry's priorities in engaging with the new or the returning administration, as the case may be. Hopefully we'll know by next Wednesday at the federal level. We have a chief economists roundtable with Svenja Goodall, the chief economist of the Zillow Group, and the chief economist of the National Association of Realtors, talking about the economic outlook in 21. We are continuing with our series focused on the experience of Black executives in the real estate industry, and are being joined by 4 really distinguished colleagues who are going to talk about their experience, again, as Black executives raising capital for their own funds, but also raising capital in some cases to invest in historically underserved communities. So that has been probably our most widely subscribed program series in 2020. And we made a commitment very early on that it would not just be a moment, but it would be something, it would be a conversation that we would help to sustain even if the broader world's attention shifted. And so that we will actually kick off the capital markets conference next week with that panel. Sessions on underwriting, distress and restructuring. Ed Adler's joining us for that, global debt capital flows, ESG in the capital markets. Overall, more than 50 chairmen, CEOs, and board members are on the agenda. A couple of special breakout sessions and meetups. We have a next gen women in the capital markets meetup that we're actually doing with Girl Gang. If you're early career in the real estate industry, please make sure to join us for that session. It's going to be a lot of fun for women in the industry who are relatively early in their career to, again, just build their networks during a year where building your network has been a little bit more challenging than it has been historically. We also have a Pride meetup for LGBTQ attendees at the conference. And are going to announce more details of the scholarship program that we announced for LGBTQ students last year. Overall, we have more than 1,000 people registered already for the all access sessions. All of our general sessions are completely complimentary this year, but you do need to register by the end of this week or by Monday because we are running out of space on our online platform. For today's session, let's get into it. Use the Q&A feature to pose your questions for Craig. And use the upvote feature to either like the questions that you want to see rise to the top or to comment or elaborate on the questions that have been asked. If you see my eyes darting around over the course of the next 40 or so minutes, I'm not checking my email or my text messages. I'm looking at the questions that you're dropping into the list. So with that, again, just absolutely delighted to be joined by Craig Solomon of Square Mile Capital. Craig, thanks for being here. You are the co-founder and the CEO of the firm. Maybe to kick us off, tell us a little bit about the business.
Sure. Well, I'm happy to participate. Sounds like the program is as rich and diverse in its offerings as it's been since I've been in the business. So congratulations to you and your colleagues. How do I describe Square Mile? Well, broadly stated, we're a commercial real estate private equity firm. I founded it in 2006. So we've been at it for some time, 2006-07. Today, we're about 8 billion or so of regulatory AUM. We're registered by the SEC under the Registered Investment Advisors Act. It's difficult to generalize, but I would say that approximately half of that equity under management drives our credit businesses. And half of that equity under management drives our equity businesses. And within those two broad categories, our credit businesses include construction lending, commercial real estate construction lending, value add lending, and a variety of other programs for various institutional investors around the world that take advantage of single asset securitizations, and variety of other sort of lower yield strategies, which are effective for insurance companies looking to match liabilities worldwide. And on the equity side of our business, we drive our opportunistic fund series. We're on Fund 6 at the moment, as well as a large preferred equity program, as well as a standalone, relatively small but standalone hospitality business.
Yeah. Our participation in this series is primarily industry, but we do have students from all around the country in different real estate programs, certainly here at Shack as well. Many of them are curious about how it is that you become a founder. How do you raise that first round of capital? What was the experience? Where did your first capital come from?
So, I was a real estate finance lawyer. I started my career at Paul Weiss, and left after a handful of years to go out and sort of scratch my entrepreneurial itch. And I did it at a time when I was relatively, well, was lucky in the sense that I had a lot of relationships in the business, which allowed me to start investing and creating my own commercial real estate investment platform. Unlucky in that I managed to leave the comfort of a large law firm shortly before the real estate crash of 1990. So that drove me to continue to practice law as a means of putting food on the table. And that experience allowed me to begin to represent some of the early real estate private equity firms. Just to give you a broad sense of what that means, as a lawyer running my own law firm, I was representing Cerberus Capital when it had $125 million under management in the entire company, not for real estate. And maybe that's 22 billion today or something. So my sort of tentacles were deep in the early stage real estate private equity world. And there came a time when it was right for me to make the transition, and we had the opportunity to start Square Mile. So our first vehicle was an institutional style vehicle of approximately $500 million, which was about as ill-timed as my departure from my law firm, in that it was investing, sort of at 1159 of the GFC, if you will. We had some false starts along the way, but managed to fight through it.
Yeah, no, this is
the industry was different. It was less mature in 2005 and 6 and 7, and the way I would describe it, Sam, is as follows. Back then, there was scarcity premium, so things were going great. Real estate private equity was just growing, and if you had any stash place, investors would rush to you if they believed you had the infrastructure to be a good fiduciary, because God forbid they were not in your fund, they would miss opportunity, right? That as the industry evolved, it switched on itself, right? And largely investors say, well, wait a minute, why am I investing in a blind fund vehicle? I can wait until that vehicle has raised capital, has made some investments, and give me something to underwrite. So as the industry matured, the scarcity premium propositions changed dramatically. So it gets harder and harder, and that evolved even further to so-called co-investments, where large sophisticated institutional investors were like, I don't really want to invest in a fund, but if you have a big deal and you need capital, show me that. Yeah. So that we happened to start at a time when we had the scarcity premium. I happened to start at a time we had scarcity.
So now the benefit of all of this experience, if you could go back and say, gosh, I wish I had done this a little bit differently, when I was, kicking things off with Square Mile, is there anything that that you would be telling your younger self now?
Yeah, don't turn $500 million into $300 million, because it makes growing your business that much more difficult. No, in all seriousness, as experienced as I was as a real estate finance attorney, having the judgment and the experience to try to understand where you are in a cycle, and try to relate things such as the debt capital markets, and where are they in terms of attachment and detachment points, and how much leverage is there in the system, and what is supply demand. All of those fundamentals were in front of us, during those heady days of 2005, 2006. Just very few people were appreciating them. And so my thought would be, step back and try to put your investment in the context of the marketplace and the real estate investment cycle, and sort of exercise some judgment, remove yourself from the deal itself, and put that deal in the context of a broader market environment. And the other thing I would say, and I say it all the time, and anybody from the firm who's listening has heard me say it 1,000 times, no matter what you think, it's going to take longer and it's going to cost more, plain and simple.
Yeah. So fast forward 20 years or so, you're doing, or to 2020, you're doing some of the most interesting deals in the market. And I've been reading about, and so I have to ask you, tell us about Silvercup Studios.
Sure. Well, let me try to put sort of that in the context of how we think about real estate investment.
Yeah.
I tired somewhat of simply being a receiver of potential deals, and having sort of a formulaic approach to those deals. Oh, you need money, we have money, we'll give you 85% of the money, you put in 15%, and we'll just do. And we started to get more interested in stepping back and evaluating real estate investment in the context of the environment in which we live, and trying to identify trends in the way that we live, what that impact would be on real estate, and developing a theme around that. And if one could identify that theme, then really loading into it, having conviction and going. And so a few years ago, the studio space, broadly speaking, met those standards for us. What we started to see was that, and I had some prior experiences in the business, but what we started to see was that studio sound stages, as a result of the advent of streaming and the fact that we're all looking at content, if you will, on our phones and on our computers, and not just on TVs, and we're less focused on network TV and broadcast TV and more focused on third-party produced content, we started to see a few things. The first thing that we started to see was that as a result of the huge demand for content, because content drives subscriptions, and the only difference between Netflix and Hulu and Amazon and Fox and this one and that one is the library of content, because it's just a battle for subscriptions. So we started to see that there was not enough places to produce the content. So what is that? Well, that's kind of a classic supply-demand imbalance, which, right, is sort of not very complicated. So what did that supply-demand imbalance yield? It yielded a willingness on the part of the content producers to obligate themselves to pay rent for a longer period of time. So as compared to, call it 20 years ago, where the production would be independent, it would be capitalized by one of the networks, for example, or one of the movie studios. Go out, get space, film for 9 months, leave us alone. Go do your thing. It gave way to, no, we want to lock up space for 3 years, 5 years, 7 years, 10 years. And we're so concerned that we'll do it. We, the streamer, will do it. So now all of a sudden you had credit. So you had duration of lease, and then you had credit, right? And then the third thing that happened, they said, and you know what? This is sort of, for us, a holistic environment. So we want our creative office. We want our production support. We want our talent. We want our production executives on site. So now all of a sudden it had an office component. So when you wrap all of those things up, it seems like a real good real estate investment with scarcity. And so we piled in. We bought in partnership. We bought CBS Television City. We bought Manhattan Beach Studios. We recapitalized and are redeveloping Culver City Studios for Amazon as their video headquarters. That's a 1 million square foot, and we're building a business, and that business involves owning best-in-class soundstage and creative office campuses, really worldwide. We just announced, we haven't announced, but we just signed a contract to do a very large development in London, on the same thematic investment basis.
How has getting these deals done during the pandemic? There's some obvious ways in which it might be more difficult, unexpected ways in which it might have been difficult, things that maybe just proved to be a little bit easier than you would have thought, given the current environment.
Well, so there's two aspects to making money in that business. One is the leasing of the space. The other is the renting of the equipment. The grip and light. Like 3 years ago, I didn't know what grip was. Right? It's the metal. It's the metal piping. I learned that. $2 billion.
And I just did. So.
There you go. $2 billion of it dawned on me what it was. So if you think about it, because of the need for content and because of the impacts of COVID, there was no filming going on, but there were long-term leases, so the rent was paying. And as compared to a New York City office lease, where there's the shadow sublease market and these concerns about supply, no such thing in the soundstage business. So everybody was paying. So there's no impacts of COVID in that regard. Our business happens to be vertically integrated in that we own the largest provider of grip and light and design services in the world. Actually, we service over 300 stages worldwide. That was severely impacted because while they may be paying the rent, they're not filming, and they therefore don't need to rent the grip and light. So, it didn't necessarily make it easier, because over the course of pre-COVID and COVID, all of a sudden the media business is becoming sort of an accepted institutional asset class. It's building on itself. It was really funny. It was building long before Blackstone recapitalized Hudson Pacific Partners, but Blackstone gets a lot of press, and now all of a sudden, everybody sort of is interested in it. So we haven't missed a beat, because the investment thesis has secular tailwinds, right? Both in the context of the recession, because one might give up their vacation, one might give up their going out to dinner, but they're not going to give up their $9.99 to Netflix. So there's a context of recession resistance, we thought was material. And then in addition, in the world of COVID, which I think is a short-term sad phenomena, the stay-at-home, you watch a lot more TV. So all the fundamentals for a longer-term investment thesis were there, and fueled, if at all, but if any impact, fueled by COVID. And we think it'll be a hockey stick return as soon as we're filming in most of our locations, including Silvercup. We've been really at the forefront of trying to figure out the right protocols in partnership with the various unions and the various streamers, because they need to get back to it. And on the grip and light side, we think it's just going to be a gigantic hockey stick return, because of the need to fill in from last season and continue to film for future seasons.
So you'll invariably have some younger folks listening in on this will say, I know core commercial real estate. I know about how to underwrite an office building. Craig is incredibly entrepreneurial, because he saw an opportunity in studio space and said, I'm just going to learn what a grip is. Is that what it came down to?
Well, so we're lucky that we have it's a business. We have a partner in Hackman Capital Partners. And so we operate this business, and we learned the business together. But it started out as an entrepreneurial instinct, and nothing more, driven by, as I said, relating the opportunity to the world in which we live, and determining that there was a positive sort of theme at work as we changed how we consume content, entertainment, and that it was, as I said, it had secular tailwinds. And then we learned it, like everything else. You just dig it and you learn it. And if it's compelling, then folks will understand why you're doing it.
So when we think about sort of the underlying changes, the long-term changes in the way we're working or living or consuming media, a lot of the time attention focuses in the real estate sector on the downside for retail. But on the upside, like this, are there other hockey stick opportunities that you're looking at?
So, when we think about our equity investment, we think about it in sort of a barbell. And in fact, when we think about our whole business, we think about it as having capital available in every part of the capital structure. That's why we have a credit business. That's why we make first mortgage loans, because if the equity proposition is not compelling on a risk-adjusted basis, perhaps the loan opportunity is. And so we try to fill the entire capital structure so we can dial up and dial down risk as we see it in any given investment time frame. So when we think about our equity investment, we think about it similarly, and we think about it as a barbell. So on the one side of that barbell, you have these thematic, if you will, investments, which are often tied to how are we living our life in the new economy, technology-driven investments, not tech, real estate prop or whatever you call it, real estate, but real estate impacted by the changes in technology. And on the other side of it, we think about, certainly in this environment, distress. And so we try to create a blended portfolio of both. So in answer to your specific question, we've been a substantial buyer / developer of last mile logistics. Similar hockey stick approach, to a very large degree driven by COVID. It's similar to the media business, though, also driven by secular changes in how we go about consuming goods and services, or certainly goods, right? If you live in an apartment building in New York City, you can see that they're all ill-designed to receive all the Amazon packages they're receiving every day, and they're piling up in the lobbies. And so, we acted upon sort of that instinct as well, not broadly industrial, which is also obviously a very accepted and institutional asset class, which is done well, but because there's not as much return, but focusing on the last mile, where in urban environments where there's a scarcity of product, can create the kinds of returns that we seek in our equity investment business. So that took us for example, to the large development that we're doing in the Bronx on the side of the old Whitestone Cinemas, which is a 1 million square foot last mile state-of-the-art facility intended to service the last mile. Yeah. It's a 20-acre site.
For those of us who were in the workforce in the 90s, you'll remember that this term last mile actually has a fair history, and it actually used to refer to the last mile of internet access into people's homes. There was a time when we were all using dial-up modems, and had a very familiar tune to it when you would sign into the internet. But the discussion around the last mile was, hey, you know what, to really unlock the potential of the internet, we've got to get high-speed internet into people's homes. What we thought of as high speed at the time was much more modest than what we think of now. But that tough question of how do we actually get the physical infrastructure in place that we can have high-speed internet access in people's homes was the last mile of the 1990s. So Craig, you mentioned that COVID is a relatively short-term phenomenon. So much of the discussion in the real estate market is about the changes in behaviors that we've seen during the pandemic. From your perspective, which of those changes might exhibit significant persistence, so that even in an environment where, keep our fingers crossed, we've got both a highly effective vaccine, one that is widely adopted, the comfort level is there to resume pre-pandemic norms of behavior, are there changes that result from the pandemic that just have persistence? And maybe some of that is work from home, but what are some of the other things?
So, I have an instinct about it. I obviously don't have a crystal ball. I have an instinct about it, which is driven by behavior that I've experienced, and certainly real estate investment behavior post each of the other real estate, the crises that we've experienced in this country, whether it be the RTC bank failures of 1990, whether it be the long-term capital growth, for those who know what I'm talking about, which was another black swan event that affected the real estate business substantially, whether it be the GFC or whether it be this. And I grant that this is very different from each of those others and those that preceded it, because those were all financially driven, whereas this is health crisis driven. But I think the behaviors don't change, including 9/11. So my instincts are that the changes that we'll experience long term will be on the margins, and that sort of large employers will be more open to having parts of their workforce work at home on some basis, but that the death of the office, to the extent predicted, is incorrect. The other thing I would say is there's a way of tracking this in terms of the impact on large cities, because this is a weird one. This is an inside-out crisis. The areas of the country that are getting most impacted as a financial matter, as a real estate matter, are the largest and most vital urban centers: New York, Los Angeles, San Francisco. Whereas sort of the secondary cities, if you will, Austin, Nashville, Miami, much less so, across asset classes. And so the question longer term for me is as simple as follow the talent, right? Follow the talent. So where are the demand drivers? Where are the best educational institutions? Where do people want to be in their careers? And if the talent starts to eschew 24/7 work-life environments like Manhattan, like San Francisco, then I think there's a more durable change in how we go about business. Um, I have my doubts about that. I have my doubts that cities like New York City, San Francisco, London are going to stop somehow being the leading cities of the world. If you look at the demand drivers in our backyard, you've got the educational system, you've got the hospital system, you've got the arts, you've got the legal. It's the leading financial. It's the home of the financial services industry in this country. It's a rich environment. And that's what attracts the best and the brightest to this environment. If that changes over time, then I think we could see significant changes. And it would be as a result of COVID. I'm dubious.
For students listening in, this is the second time this week that the RTC has come up, which is an unlikely thing to have happen. So please don't skip that chapter on history of commercial real estate. Anne, who joined us on Tuesday, was at the FDIC during the Resolution Trust Corporation era. So please go back and visit that chapter if you skipped it earlier in the semester. It's a critical time, a formative period in the history of modern commercial real estate. Craig, you and I were chatting earlier about how some of these issues in the election, are so material, but maybe not getting as much attention as the headline race are at the local level. The urban NYU's Urban Lab is housed at SHAC. Richard Florida, myself, Matt Kwatnitz. A lot of our work is focused on right now, the fiscal outlook for cities, and in New York, certainly to your point about the largest cities, the most vibrant, the ones that are ultimately the engines of innovation in the economy, facing the most challenging fiscal outlook. What is your prognosis? What are your instincts with regard to how well in the policy environment, in the budgetary environment, New York is able to manage its way out?
Well, I'm no expert, although I have lived in New York City for a very, very long time, and I've seen New York City with substantial budget deficits, with substantial problems, and find ways to work through it successfully. I think that the likely result of the presidential election, without getting into my politics, but the likely result of that election, I think, is to reduce the heat on this blue versus red phenomena in this country. And you will note that it's the blue states that are facing the most significant challenges in terms of budget deficits, in terms of high taxation, and in terms of the wealth and brain drain to lower to states in which there is a lower tax burden, right? And I think that tax policy, fiscal policy, in the context of the new administration and Congress as it appears to be shaping up, will lower that temperature. And if you lower that temperature so that there can be healthy dialogue, then I think cities like New York, which are going to be, Los Angeles, San Francisco, you just keep going. If with that lower temperature, I think that there can be a federal and state, partnership, if you will, so that tax policy, fiscal policy, and the states and cities, how they address these issues, can be more cohesive. So I'm not a believer, for example, that people are going to, like you read about everybody moving to Florida or moving to Dallas. I think that what you find is the C-suite moves, but the rest of the train stays, right? Which is where all the value is added. So I think it's kind of overstated in terms of the loss of tax base. But I think we have real significant issues that have to be addressed.
Yeah, and if there are folks for whom this question is of interest, please do follow up with us. This is a major area of focus for us at the Urban Lab. And of course, Richard Florida's work A lot of his commentary is also available on City Lab, which he's now moved over from the Atlantic to Bloomberg. But this issue of managing our way out of the crisis, what is the interplay of business resumption plans in different cities and dependence on the public transportation infrastructure, which in many cases, certainly New York, is coming under significant pressure. These are all very, very real issues that have the potential to define different trajectories in the recovery of different cities. But also to Craig's point, for those of us who are in New York, I think our instinct is that we always have pulled through, and we always will. It's just going to be a lot of work, to get to the other side. Go ahead.
I mean, I was going to say, Sam, to that point, I don't know a lot of people who have made a career betting against New York City.
Yeah.
And I know a lot of people who have taken the view that New York City is, the greatest city in the world, and finds a way to work through its problems. And investment made from that perspective has always seemed to reward, and certainly in the modern era, that approach. And the only thing I would just throw out for folks who may not have context, if you look at the world and you look at the flow of capital worldwide, the US and the major markets of the US continue to be the belle of the ball, if that's an okay expression. We have an orderly system, may not feel like it right now, but we have an orderly system of government. We have a rule of law. We have a demonstrated statutory way of foreclosing on a piece of property, of exercising remedies. There's a semi-understandable tax code. And as a result, it is considered a safe haven for capital, even at this time, and even with all the changes that we face. And that's not changing, and hasn't changed. And I think that speaks volumes for the US bouncing back from this. And I think in that context, for the gateway cities to lead that bounce back over time.
Yeah, so Craig is foreshadowing Larry Silverstein's keynote next week, where he'll be talking about New York City's comeback. So I appreciate that.
Marty asked me about that on the golf course, so I gave him all that, and so that's how
I can see your clubs behind you, by the way, but I also see it looks like you might be a bowler there. Are those bowling pins?
Yeah, they're like antique bowling pins. I have no idea.
Okay, yeah, we've got a little bit of time left and about 10 questions. I don't want people to think I'm ignoring them. One that's and let me know if you want to pass on this particular one, but a couple of people are asking about your thoughts on the single family business, and perhaps what they're alluding to might even be single family rentals as its potential as an institutional asset class.
Yeah, no, I mean, listen, we have not engaged in it. It's a business that has to be engaged in scale, very substantial scale, to create the operating efficiencies. But from what I know and from what I've studied, I think it's got real legs. And I don't think it's necessarily just a function of the affordability component of renting versus buying, which is something whenever we do multifamily, we always think about. I think there are other aspects of it that make it a keeper as an asset class. So I would say I don't exactly know where in the cycle of its growth it is. I'm not clear whether it's fundamentally making money or whether these are capital markets and financial transactions that are causing money to be made. So I haven't studied it that much, but big picture, I would suspect that it's an asset class that is going to find a home among our asset classes.
Yeah. Well, the next thing I want to ask about just brings us back to one of the poll questions from earlier. It looks like the sense amongst participants in today's call is that we could reach a peak in distress as late as a year from now. What is your own intuition, your own sense of what the distress cycle is going to look like, and the ways in which available distress matches up with or doesn't match up with the available capital that's looking for opportunities?
Sure. There's a few things I would say. I would distinguish this crisis from the global financial crisis, in addition to the fact that this is self-driven, simply by a function of a relatively disciplined capital markets between the GFC and the advent of COVID. So we are not looking at an over-leveraged commercial real estate investment market pre-COVID. So that changes the distress dynamic fairly significantly. I think that's important. In addition, if you look at supply and demand fundamentals across most asset classes, well, relatively in equilibrium, right? In fact, the conversation, Sam, pre-COVID was certain markets, maybe multifamilies, is getting a little out of whack, right?
Yep.
But by and large, we were in equilibrium. So those are not the ingredients of a massive distress opportunity, in my view. So here's what I think. I think that there will be sort of episodic opportunities driven by debt maturities and driven by the fact that there has been a value decline. Certainly that value decline is impacted more on land values than on cash flow. Because if you've got weighted average lease term and credit and cash flow, we're in such a low cap rate environment that's more sustainable. So I don't think it's going to be, harkening back to our RTC days, it's not going to be this feeding frenzy. I just don't believe it. I think there will be opportunities, but they will be challenging to access. And I think they will be less scaled opportunities to buy large non-performing loans in order to get to the real estate, and more the utilization of structure, more the utilization of rescue capital to support investments which are in need of deleveraging, or in need of tenant improvements, or in need of some sort of capital infusion to stay the course. So I just see this one as different in that regard. There's a lot of capital on the sidelines. We're relatively reasonably leveraged industry. And it's a far more sophisticated industry than it was in the past. So that's my view on what the opportunity is going to be, by and large. In terms of timing, these things, real estate's illiquid asset class, and real estate has debt which mostly has term. So it takes a long time. So sure. I think that, on the margins, there's been some opportunity in 2020. And we can talk about hospitality as a separate issue. But I would say that you're going to start seeing the opportunities arise and scale in the back half of 21. And I think the meat of the opportunity, and this may not be a happy statement, is in 22 and 23, because it just takes a long time for capitulation to occur. The process of capitulation, it's like the 7 stages of grief. It takes time, right? And so I don't think people are missing opportunities as we sit here today in November of 2020. And I would say, stay the course. One does not have to buy at the absolute bottom. I think we get paid for trying to buy when we have some transparency into where things are going, which is sort of a leader into my thinking about hospitality. Is I, for one, don't think we should be trying to guess on what the burn rate is to carry a hotel which is closed, and not knowing how long it's going to open and how long it's going to take to stabilize. I would leave that for others. I would like to see the hotels open. I want to look at the data across the country and specific markets. And when I start to see things coming off the bottom, maybe I leave a little return, but on a risk-adjusted basis, I'm happier. So I think that's a longer process as well. So for young people listening, I would push the whole thing out a few years. So I disagree with the results of your survey. I was on the long end of the survey.
Fantastic. No, that's a great insight. One more question for you. You've been super generous with your time, and I appreciate it greatly. We do the series is sponsored in part by CREFC Commercial Real Estate Finance Council. They've been wonderful partners for the Shack Institute, and we have a number of their members that are tuned in. We often get questions for our guests around their expectations for the resilience of different capital sources. What is your sense of which ones may be relatively more modest participants in the market than they were pre-pandemic for the next little while? And in particular, do you have specific thoughts on the outlook for CMBS volume?
So look, I think CMBS volume, I think it's found its equilibrium. I mean, I think the days of 300 billion of issuance, I don't know that we're going to see them again, at least not in my career. I think it's found its sort of market trading range in terms of volume. I think it's probably been a net beneficiary of COVID. I don't really follow it that closely because we're not flow traders. Our lending business is on balance sheet. And the reason I say that is because there's a tolerance in the context of a pooled securitization, a pooled trust, to spread risk and to finance assets which might not be necessarily otherwise financeable at the same level, and to look at cash flows and sort of, I don't know, how do I put this gently? To not be quite as disciplined in the application of basic underwriting principles as on a one-off basis. So I think CMBS will continue to do reasonably well. I don't follow the margins like I used to. I mean, there's times when you can make 6 points on a CMBS trade, a CMBS portfolio, and there's times you can make a half a point. I don't exactly know where it is. I think it's more driven by the relationship of yields, corporate yields to bond yields, so that the appetite of investors. But I don't think it's going anywhere. But I don't think it's going to occupy as big a piece of the capital markets pie as it did sort of pre-GFC. I think the debt funds are absolutely here to stay. And I think those debt funds who are insane enough to want to build the infrastructure to have at it will grow. And those who have been conservative about their application of their own leverage and have not overly accessed the CLO markets or mark-to-market repo facilities with recourse, have a real market share growth opportunity. I consider Square Mile among those, having done about 22 billion of origination since we started that business 6 years ago or something, and having taken a conservative view to our own leverage. So I think the debt fund world is going to occupy a larger share going forward of the overall pie of lending. And I think the commercial banks are on an inexorable path towards occupying a smaller share, just because of the regulatory framework and the like. And then you have the insurance companies that, for sort of institutional quality, long-term cash flows will always be there. So I think there's plenty of capital, and will be plenty of capital for good opportunities on the debt side.
Craig, this has been just fantastic. It's so great to hear your insights. You've been very generous with your time. Really appreciate your joining us today, and
my pleasure.
Always so fascinated to see the amazing things that the team is doing at Square Mile.
I appreciate it, Sam.